I think there's two major things that really caught my attention. The first was just yields. I think we were in such a extended period of 0% interest rates from after the financial crisis. So 2010, 2009-ish, really 0% rates lasted 10 years until COVID. Inflation came back in the 2020s. And I think what a lot of people are starting to realize and seeing is that, yes, the Fed has some impact on yields, but they only really affect the shorter end of the curve. And I think what really gets lost in the shuffle is what's happening in that 10-year treasury. So like Aaron was showing in some of his charts, that's driven by market dynamics and predictions. And for a lot of 2024, I'll get into it a little bit deeper as we get into my predictions, because something I've been harping on a lot is that I think the markets and the Fed were very disconnected this past year, where the Fed was signaling we're going to maybe cut rates a few times while the markets were pricing in a significant, more aggressive cuts. So what that caused is some kind of shifting. And so what we saw actually in 2024 was the yields on US Treasuries, both on the short end and the 2-year, but also on the 10-year and the 30-year, which aren't controlled by the Fed, actually rose in 2024. So the Fed cut rates by 1% throughout the year, and yields across the US Treasury curve went higher, meaning borrowing costs were raised over the past year. Mortgage rates are now about roughly the same, but let's call them slightly higher than they were to start the year. I think that surprised a lot of people who have been kind of waiting on the sidelines for, hey, like the rate cuts are going to drop rates and lower my borrowing costs. That didn't happen, which you would think would be a negative. But as Dave said, the markets were up 25% in a year like that. And I think there's something to break in deeper for 2025. So I'm going to hold off there on exactly what kind of that means is that higher rates maybe aren't a bad thing for the economy if they're higher for the right reasons. But what that kind of I think leads me into my second point here is when expectations and when investment managers, we call that active management. You're actively taking a position that's different than the market. So you can invest like the market and just get market returns, but a big piece of the industry is about active management. And what's interesting about 2024 is for the third straight year, active funds saw major outflows. And so I have a chart here which kind of shows the pace of it, but we hit the largest record outflows for actively managed funds in 2024 of $450 billion were pulled out of actively managed funds, higher than last year's, which was 413 billion. And it's mostly looking at active mutual funds. I think some clients with mutual funds are where the active management has mostly been. So just as a quick jargon breakdown, mutual funds, basket of individual stocks that are run by investment companies. So you buy one share of the mutual fund, but you get broad exposure to various stocks. And what you're doing is you're trusting the manager of those active mutual funds to really outperform the index. Well, since the launch of ETFs and index tracking products, I think there's been some big shifts within the asset management industry. And there's been more focus on, moving away from higher cost, actively managed mutual funds into kind of passive investing and index tracking. And when you look, last year with the index up 25%, a lot of that money that was coming out of actively managed funds was going into index funds. Well, if people are just buying index funds with that 450 billion, I think that contributed to the outsized returns that the index saw versus, the broad market maybe overall. And, when you look at it, I think it's a little bit about performance, honestly. Active managers have really struggled against the benchmark for some period of time, and 2024 was no different. As Dave said, the S&P 500 was up 25%. Well, if you look at the Morningstar large blend fund category, so about 1,300, 1,400 mutual funds, ETFs that are within this large US blend group, so large US cap stocks, the average return of that group of those 1,400 stocks was only 21.5%. So 3% behind what the index did. If you just got index like returns, you were in the top 25th percentile of that whole group. So just buying the index, you beat 75% of all those other active managers of those 1,400 funds in that same category.
Mm.
And I really think that's something that's getting lost in the shuffle is I think a lot of people like to think that they need to outperform the S&P 500 by this wide margin at all times. Well, really, I think what drives long-term success, or maybe I shouldn't say that because a lot of things drive long-term success, but a big contributor to that is consistently outperforming. So maybe performing every year by just a little bit over time, or even looking like the index, you can get much better results than trying to, swing for home runs in any given calendar year. And I think the data really bears that out. If you look at the annualized 15-year return of the S&P 500 ETF, so ticker SPY, looking at that same 1,400 groups of mutual funds, you'd be in the
Mhm.
13th percentile. So you'd be
Mm,
better than 87% of other managers if all you did was just get index-like returns.
mm,
So in a year where, people are trying to figure out what's going on and active management, is it really beneficial? Is this the death of active management? I don't think so personally, because I think there's ways to outperform by small margins over time, but looking for just giant alpha or outperforming strategies has really been a tough kind of hill to climb. And so I think what you're going to see more of, and what we do at Monument, as I would say, is what we're doing is we're actively managing passive investment funds. So we use lower cost ETFs that look like indexes or other factors, but then making shifts or tweaks using those cheaper funds than those actively managed mutual funds. A lot of advisors were just putting their clients in actively managed mutual funds, paying high internal expenses, and then charging an asset management fee as the advisor. So what you're doing is you're helping clients by charging less overall when they look at their total net investment costs, but also then too still having that active management to hopefully get index like or even just slightly better than the index performance. So I think that's an interesting shift that we've seen over the past, if looking at the chart, it goes back to all the way 2008, but you see a lot of in the past 3 years, significant outflows of active funds because overall, people I think just kind of want to have passive investments and manage their portfolio. So not necessarily always take the passive approach, but actively managing those passive funds and exposures.
mm.
So that was really interesting to me in 2024,
Yeah,
just
I
kind
think
of the
that's an interesting
dynamics.
trend. Yeah.